Welcome back to 15 Minutes of Finance. My name is Brandon West, a CPA here at 77 Financial Group, and I'm going to help you keep more of your money. Today's episode is how are you building wealth? We're going to talk about the three primary asset categories that make up someone's wealth in retirement, and we're going to talk about some benchmarks to see how are you doing compared to the average American. Are you on pace? Are you behind? Or should you feel great about yourself? You've been investing early, investing often, and you're killing the game. So it'll give you a really great idea of how your retirement planning is going. And it's a really great time to ask yourself, how much money am I going to have in retirement? And I'm going to guess about 95% of you do not have an answer to that question. And if you don't have an answer to that question, it's a really great time to start retirement planning and getting an idea of your retirement. There are countless people who go through their careers just investing in a 401k through an amount that just seems to make sense to them, or maybe it's an amount that is the minimum in order to maximize the employer match, right? Maximize your free money. That's traditional wisdom. Sure, do that. So they're investing a sort of arbitrary amount in their 401k. They retire and they go, okay, that's how much I have. There's no planning going into it. So do you know on average what you're returning on your investments? Do you know what your home equity is going to be at what age, when it's going to be paid off? On average, how much is your home appreciating every year? Do you know what you're going to get, what you're on track to get for Social Security in retirement? If you don't know the answer to these questions, you should start answering them now. And it does not matter how old you are. You should be answering those questions for yourself. James says this all the time. Failure to plan is planning to fail. And so if you have no idea what your retirement picture looks like now, you're not going to know until you retire, and that's not a good place to be. So we're going to talk about the ways to build wealth in retirement. How are you building wealth in retirement? But first, I want to give a quick shout out here to Daniel on Spotify. Left a comment on James's last video saying, I really appreciate how clearly you break down complex topics. Your analogies help me explain these concepts in class discussions with both classmates and professors. Keep up the amazing work. Thank you, first of all, so much, Daniel, for your engagement with the podcast and for the kind words. We really, really appreciate it. And also remember, you and everyone else listening, leave a comment on the videos on Spotify. Send us a direct message at westonwalters.com. Reach us however you would like. Send us a DM on Instagram, 15 Minutes of Finance, whatever you want to do. Send us a question and we will answer it, and we will talk about what you want to learn about and break it down for you so that you understand it. So we'd love to hear more questions. And obviously kind words are great too. So if you just want to leave a compliment, we definitely welcome those as well. So all right, let's talk about wealth building in retirement. Now, I'm going to say up front that there is a fourth category here that applies to a very few amount of people, but I do just want to cover it because it's not a core element of the retirement planning discussion, but for some people, it is the core of their retirement planning, and I'm one of those people, and that is business wealth and the value built in business for an eventual business sale. Okay, so I'll be completely honest, I probably have less invested than you would think I do. Okay, so I have been for years now putting all of my money into growing my business. That's trying to increase revenue, trying to get more clients. Obviously, we just got an office. We're currently building a studio to grow the podcast. All of our investments have been back into the business to grow the business. And in terms of our very, very long-term retirement planning, eventually passing off this business and selling our business is a primary driver of what we do and what we're going to continue to do over the next 30 to 40 years. So there are people, there's super successful landscaping businesses that have recurring clientele of, 1.5 million dollars a year of recurring landscape maintenance revenue. That's a very scalable, sellable business, right? So there are people whose retirement plan is that nest egg of selling the enterprise that they've built. And it is a legitimate retirement plan, but the vast majority of people are not selling a 6 or 7 figure business to retire. They're building wealth through more traditional means. And that's kind of what we're going to be talking about here in this episode. So let's kind of talk about benchmarks here in terms of what does retirement look like for the average American? Is it enough? Are Americans doing well? The answer is no. But let's talk about one thing here that's very important, and that's the difference between mean or average and median. So the mean is the average. You take every single person's net worth at retirement, and then you divide by the number of people, and you get an average. What we usually look at, especially here in the United States, when we talk about averages, is the median, meaning the middle number. And that's because the ultra wealthy in the US, I'm sure this isn't news to you that for better or worse, income inequality has drastically risen in the last several decades here in the United States. Obviously, we have multiple hundreds billionaires, right, that are worth several $100 billion. So obviously those people are going to massively outweigh the scale, and, a single person worth $100 million is going to lift the average of 1 million poor Americans and make them look not poor, right? It's going to completely shift the scale. So we usually look at the median, which is kind of the middle number that allows us to not super hyperinflate the averages here. So when we talk about average here, I'm using the median just to kind of clarify that. So median retirement wealth, according to Yahoo Finance, $409,900 is the average median retirement net worth of Americans in retirement. And I believe they base this off of anyone between about 64 and 76, I think, is roughly the age group that they're looking at. So less than $500,000. Okay, so now we're going to break down what does that look like in terms of how much in assets in different asset categories do those people have. And just to give a frame of reference, the average wealth in retirement is like 1.8 million. So that gives you a pretty good idea of how much those top income earners and wealth creators distort the true, what I would consider would be a better look at the average, which is that roughly $410,000 number. Okay, so number one, retirement strategy, asset class, whatever you want to call it, is Social Security. Obviously, that is what most people are relying on, at least a big component of their retirement when they retire. So what is the average Social Security benefits? The average, meaning median, Social Security benefits in retirement is $1,920 a month. Okay, so just under $2,000, which means it's just shy of $24,000 in income per year. That is not a lot of money, guys. Okay, Social Security, less than $2,000 a month. Think about what your bills are. They might be a little bit lower in retirement, but that does not sound like enough income to cover the vast majority of Americans' bills in retirement, right? So this is the primary class people rely on, and let's be honest, it is not enough. And that's why we encourage people to invest early and often for their retirement. I talked about in my last episode, talked is generous. I ranted, let's be honest, about how inefficient the Social Security system is. And as a safety net, again, we need some form of safety net. I am not an anarchist who believes in zero government intervention. But when you compare how much the average person puts into Social Security, what they put in gets them $2,000 a month. What that amount would be from age 20 to 65 invested in the S&P 500 is about $1.9 million. That, with income generated off of it, is over $100,000 a year, right? So everyone gives involuntarily enough to retire a multimillionaire. Just about every single person in America with basic jobs. We're talking an average salary of $40,000 a year. By saving 6.2% of it, investing it in the S&P 500, for 45 years, you retire a multimillionaire. That is the power of investing early and often. Okay, so there are Social Security calculators. As you get older and you have a better idea of your income, right? If you're 30, you might still be switching careers. You might still have a lot of upward mobility in your career. It might be a little hard to get a true estimate of what Social Security will look like for you. But as you get older into your 50s and your income has sort of stabilized, you can look at one of those calculators and get a pretty good idea of what you can expect to get from Social Security, because that's going to be a big component of your fixed income, okay? Before we move on to the second category, I got a new segment for you guys, all right? A new exciting segment, okay? And this is called tax profile. And I'm going to talk about specific clients that I've worked with this tax season in ways that we've maximized their tax deductions to maximize their refund. So in this specific scenario, it is a young couple who has a side business where they reupholster and flip and remodel furniture, okay? It is not a super lucrative business where they're making hundreds of thousands of dollars. They've just started doing this. They made about $27,000 last year. But if you understand self-employment tax, you understand that even small amounts of income can create pretty big tax bills because you're not only paying income tax on those earnings, but you're also paying self-employment tax of 15.3% on those earnings. So you can very quickly be paying 35 to 40% as a functional tax bracket on that income because you're paying two different types of taxes on it, right? So you could have a $5,000 tax bill from $15,000 in self-employment income. It adds up very, very quickly. So their primary place of work is their garage. There's no personal use of their garage. They don't park their cars in the garage. It's filled top to bottom with furniture and tools to remodel furniture. So they set up an agreement to pay themselves rent from the business to reduce business income based on a fair market value of, cost per rentable square foot so that they could rent the garage from themselves. That is better than nothing, okay? It is a good idea because even though we're going to see that there's a flip negative side of this, it is still advantageous because it reduces self-employment income and therefore saves us that 15.3% on that rent expense. That's great. The flip side and why we didn't go this direction and why I shifted them away from this is because they have to now recognize personally that passive rental income that they're receiving from the business. So while they do save on self-employment taxes, it's not just a full write-off because that income deduction is now offset by personal rental income. So what we did is we utilized their garage as a home office. And the IRS says that a room used regularly and exclusively for business and as the principal place of business of your small business or your Schedule C or your self-employment, whatever, can be justified as a home office. And that allows us, based on square footage, to deduct a percentage of all of our home costs, real estate taxes, mortgage interest, utilities, internet, security, HOA fees, repairs and maintenance, all of those type of things. So this did two things for them. It allowed them to no longer recognize as income the rental income personally because they're not paying themselves anymore. They're just creating a business write-off by justifying part of their home as a home office. Okay, so now we don't have that extra income. And then two, the square footage percentage of those home costs outweighed the fair market rental price that they had established for their business. So the deduction ended up actually being higher. Ultimately, they took from about $400 and something owed to about a $3,000 refund. It was a very, very significant difference. So that's the client profile for this week, the tax profile that shows you the importance of looking at multiple ways to quantify things like home office. Next week, hint, it's going to be about business vehicles and how we save clients money. There are multiple elements of small business ownership where there are multiple ways to substantiate expenses, and an analysis with a CPA to do that can save you a lot of money. So there's our tax profile for this week. Hope you enjoyed a little insight into sort of the tax planning that goes into small business ownership. Let's get back to your wealth in retirement. All right, so we're going to talk about asset class number 2. And you could probably guess what this is. This is home ownership. For a lot of people, this is kind of what retirement looks like for them. Okay, so now a lot of people retire without their home paid off. Okay, so it's not necessarily a fully investable asset or a fully debt-free asset. But a lot of people, by the time they retire, have paid off a good portion of their home. And so their payments are lower, okay? And for people who have paid off their home, that's a huge deal, right? Even if they never utilize that money, they never sell the home and, go crazy in retirement or invest that money in retirement, they know that they've left something to their heirs, right? Their kids say, hey, We were the first generation to go to college. We didn't save a lot of money. We started with nothing, but we worked our whole lives. And here's this home that's now $800,000 that we bought for $300,000 and have worked our entire life to pay off and to leave you with this, right? It's a huge source of pride. It's a big part of what people call the American dream of having ownership of property yourself and being able to pass that off to your kids, right? So there's an emotional element to it, but also it serves as what I would consider almost a negative asset class. And here's what I mean by this. That term is not an official term. Don't talk to people about that and say my home is a negative asset class. But here's what I mean by it in the purposes of this discussion, okay? By owning your home, you usually don't utilize cash from that. In fact, things like HELOCs, home equity line of credit, reverse mortgages, most financial analysts will tell you that's a bad idea. Don't take equity back out of your home and now recreate debt from an asset that you got out of debt on and now own outright. Okay, so you don't usually want to get cash out of your home, but what it does is it lowers your bills in retirement, right? So if I have a $1,200 mortgage and I'm getting that $1,900 on Social Security, I've got $700 for everything else I have to pay for in the entire month. That's going to be tight. If I own my home and now the only thing I pay is $250 a month on real estate taxes. Well, now I've got $1,650, right? So it really supercharges your investments and your fixed income in retirement by owning your home and therefore eliminating what is the biggest hurdle to your budget in retirement, right? So when we talk about retirement planning in terms of where's your income going to come from, what are your bills going to be, what does your budget look like, are you in deficit or are you able to save a little bit still in retirement, and you're trying to figure out, am I going to be able to survive in retirement or do I got to make major changes to my lifestyle? By owning a home and getting to retirement with a home owned or mostly paid off, and therefore the mortgage is much lower, you've really supercharged the efficacy of that fixed income, whether that's Social Security or a pension or whatever, because you've eliminated a massive budget item, and therefore you don't have to be as careful with your budget and you don't need as much income from other sources because your bills are significantly lower. Okay, so there's a couple elements there to home ownership. But when we talk about home ownership, it helps with your budget by reducing costs. And obviously, it's a huge part of legacy and estate planning to leave something for your kids and start building generational wealth. Now, the average home equity in the United States is $222,000. It's not a lot, guys. What does that tell us? Most people do not have their homes fully paid off in retirement. And the ones that do, these are not massive homes. They're not Coronado homes, on beachside California. These are modest homes, or they've still got a big mortgage on it because the equity is only about $200,000. Okay, so that's your benchmark for the rest of the country. That's the median home equity is $222,000. So, regardless of your age, if you're in or before retirement, do you have more than $222,000 of equity above your mortgage built up in your home? If you do, congrats, you're above the average. Now, we shouldn't aim for the average, right? We want to have a comfortable retirement and we want to dig in now early and often to do whatever it takes to build wealth for the future, not only for our own retirement, but for our kids to build generational wealth. But that's your benchmark to compare yourself to the rest of the country. It can be good to know. All right, last asset class here, guys, and this is most relevant to what we do. All right, these are investable assets, particularly 401k plans. Okay, so the average, again, we're talking about median balance in 401k plans at retirement is between $180,000 and $240,000. Okay, so 180 is the average for people that are like 45 to 65, and 242,000 is the average from people 65 to 85. Okay, so obviously those accounts are going to continue to grow after you retire. Okay, so those are investable assets in people's 401k between $180,000 and $240,000. So we talk about people retiring, like the date of retirement, average balance of $182,000. Okay, again, I'm going to keep harping on this point. What you pay, the average, so probably if you're listening to this, you're making more than this. The average person's salary, what they pay in Social Security across their lifetime, put into a 401k or a Roth IRA and invested just in the S&P 500 for the same amount of time is $1.9 million, okay? It is more than 10 times what people have in their 401k in investable assets. So what does that tell you? It is doable to not just retire, but to retire wealthy, okay? So when you retire plan, whether you want to meet with an advisor, whether you want to do it yourself, you're 40 and you go, you're right, I have no idea how I would retire. I should probably start figuring out if my trajectory is good or not. And you project these numbers out, okay? There's 3 real things to look at. You're going to live off of your investable assets. Maybe there's dividend, interest, capital gains that you can live off of. You're going to have your home equity, potentially, that's going to limit your expenses and make you more comfortable in retirement, as well as be a pretty nice nest egg for your kids. And then you're going to have your fixed income, whether your job has a pension or for most people, that's going to be Social Security. Those 3 elements, again, you could be a business owner who's expecting $1 million payout when you sell at 55. You could be someone who has alternative investments. Maybe you're that guy that I've seen on, Pawn Stars, who comes in with like a $50 million Pokemon card collection. You could be that guy. You could have $10 million in gold, okay? But we're talking for primary asset classes that the average person plans on in retirement. You've got your home, you've got your fixed income, and you've got your investable assets. And those investable assets, that's the primary thing that you can control. If you invest early and you invest often, everybody can be a millionaire. You can earn $40,000 and invest just 6.2% of it. For 45 years, you're a millionaire. And that's at 65. You don't touch that money because you have Social Security. Maybe your house is paid off. You don't need to touch that money. By the time you die at 85 and you had another 20 years, that could be $8 million you're leaving behind to your kids, okay? So wealth building and generational wealth, it is accessible, and it's exciting how accessible it is, okay? If you invest early, you invest often, and you're diligent about investing and not panicking. And that brings us to the last part. We got to talk, all right, a little bit. I don't want to steal James' thunder. I'm not going to belabor this concept here. But I got to say, on a personal level, yesterday was a very fun day for me, all right? Market was up about 10%. S&P 500, I think it was like 9.7%. The Dow Jones was up almost 10%. All right. The markets were up after that announcement of the 90-day temporary pause on most of our tariffs. I'm sure James is going to talk about it. Stay tuned tomorrow or maybe Saturday for your market update. But I just want to shed light as we talk about wealth creation when we look at the market. Even when the market was down before that big jump on Wednesday, we were 80% up from 5 years ago. Okay. What does that tell you? If you invest at 20 years old, who gives a damn? Pardon my French. All right. But who gives a damn what happens month to month, day to day? All right. If you invested, it seemed like the end of the world. I mean, how many news articles, how many people were talking to you, how many different podcasts were talking about, oh my God, this is the largest 2-day drop we've ever seen. It took a unprecedented unilateral announcement by the office of the president to drop the market that much. Oh my God, what are we going to do? And you were still up 80% from 5 years ago. If that doesn't illustrate for you how over a long time horizon, how low risk investment in the total market is and how exciting investing is, that even when the storm comes, the storm itself is better than the sunny day from 10 years ago because the market goes up over time. And as we've talked about, if we're wrong and the market doesn't go up over time, who cares? You're dead and the country's gone, all right? What it would take to collapse the entire enterprise economy of the United States would destroy everything, so who cares, right? For all intents and purposes, the market goes up, and even the worst days, you got to live through it. That's exciting. You got to live through one of the worst 2-day stretches in market history. And guess what? Your money was still more than it was when you invested years ago. So keep investing and don't play games. All right? The only way things get really bad is if every time things get bad, you sell and you panic, right? Because then 2 days, worst 2 days we've ever seen. Then on Wednesday, we bounced back over 10%. You got a huge chunk of your money back, right? Weather the storm. That's my word to you. Weather the storm. And what's even more exciting is not even just weathering the storm. It's looking back. Go to Yahoo Finance. Go to, sign into your Fidelity app, your Vanguard app, wherever you keep your money, and look at the 10-year chart, the 5-year chart, the 15-year chart. The storm of today is more prosperous than the best market day 10 years ago, because that's how much the market grows over time. And nothing's more important than time. And if you're not investing, start investing. You don't have to pick individual stocks. You don't have to be risky. You don't have to take chances. Put money into the total market, the S&P 500. Don't look at it every day. Don't log in every day. Weather the storm, and 65-year-old you will thank 25-year-old you for how diligent you were at a young age. That wraps up today's episode of 15 Minutes of Finance. Thank you so much for tuning in to another episode. As always, leave a comment of topics you'd like us to cover in future episodes, questions you would like answered. Please share to your friends and family. If they panicked about investing, if they're stressed about retirement planning, share this episode about how we build wealth in retirement. They can see where they are compared to the median American, and hopefully that'll give them some encouragement and some tools to use to start planning for retirement. As always, invest early, invest often, and we'll see you next time.